Well, hello everyone. Welcome to the Investing Master Series. My name is Barbara Armstrong, and I have the pleasure of filling in for Mr. James Boyd, who is gone all week this week on a well-deserved week off. So, what are we going to talk about today? Well, I know that James has talked a lot about callers and protecting your position, and you'll be all grateful for that knowledge, I'm sure, today on a day when the markets are pulling back. But I thought today we would take a walk on the downside, meaning let's look at some trading strategies that will work well with stocks that are pulling back or that are downtrending. And, does this mean I think the market is headed down? Not at all. But there are some stocks that are outliers that haven't been participating in the uptrend that we have seen in the rest of the market. We'll have a quick look at the markets, and then we'll look at some bearish trading strategies. So that is what is on the menu for today. I have the privilege of having Mr. Brent Moores with me in the chat today. Brent is a friend and a fellow coach and really understands all of these strategies inside and out. So if you have any questions, do not hesitate to ask. I'm sorry, Jax will not be joining us for this webcast. I have acquired a dog recently. I will post a picture for you after the webcast. And if you have any naming ideas, would love to hear them. So that's that. If you are not following Brent and I on X, consider this your invitation. My handle at Barb Armstrong CS and Brent's is at Brent Moores CS. Okay. Options carry a high level of risk and aren't suitable for all investors. That's a good thing to remember as we go into this. As we look at these three different trading strategies that we're going to look at today, short call verticals, long put verticals, and long puts, we'll go over what the risk is with each of these trading strategies. We will do all of our examples on the Paper Money software application on the Thinkorswim desktop platform. This is a brilliant place to learn, to hone your trading skills, to make sure that you are aware of just what's going on. And that make sure that you understand your strategy before you consider it trading it in a live account. And just because something works in Paper Money, by the way, doesn't mean that, if you trade it later in a live account, that you're going to get the same results because the market continues to change, right? Right. One of the differences between Paper Money and a live account is that short options will never be assigned early in Paper Money. That can happen in a live account. Okay, so we're going to go out, have a look at what's going on in the market. We're going to look at how to take advantage of stocks that are moving to the downside, and we're going to do that by placing some example trades. Okay, so let's get out and start looking at the market. So if we look at our S&P 500, it's up 11% year to date. I have a 10, a 30, and a 100-day moving average on the chart. And this has now broken down below the 30-day moving average, and it's approaching the 100. It's also approaching this previous low. But what might be making some people nervous is that this is the first time, well, let's go to a year-to-date chart. This is the first time since April that we are seeing a lower low. We had a low here, and now we're seeing a lower low. Does this mean Chicken Little is out doing laps? No, but she may be warming up. She may be starting to warm up, but, we're still above the 100-day and we're just approaching this previous support level. We'll see if that holds. So, no need, to be, in a panic. But, what James has been talking about with respect to collaring positions and adding protection, that has merit. Okay. And, yesterday I drew this diagonal support line and it was holding. I did the same thing on the SPX and it is breaking below that diagonal support line today on the NASDAQ and on the S&P as well. If we come and we look at the S&P, I redid my line because yesterday I had drawn this line. Oops, I guess I have to change my drawing tool, Earth the Barb. And so this is a break of that diagonal support line. And how about the Dow? We're seeing like similar stuff all over, right? We had kind of a diagonal support line there. It's breaking below. But, this index still up almost 8% year to date. The NASDAQ up double that. It's up 14.8% year to date. So, this uptrend, it's being threatened, but, it's still above the 100 as it has been since, the middle of May. So we'll just wait and see. This could be a breakdown and, like I say, a breakout, and it could be a fake out. Tomorrow, it could be right back up. We just don't know. And then if we look at our small caps, this is 2,000 of the smallest companies that are part of the Russell 3000. And this is continuing to break down. And this one of the 4 indexes is the only one that is now below that 100-day moving average. And we had a bit of a support level here, and it's breaking below that. So we're seeing lots of, breakdowns happening here. Yeah. So Kelly is saying, it broke the diagonal support line, and you're absolutely right. Okay, so what do we do with this? Well, let's come and look at, let's start with Starbucks. So Starbucks has not been rolling along with the rest of the market, right? Like they may be fueling the caffeine that has been driving the market, providing the caffeine. But, this has been downtrending. It went from 117 down, to where it currently is at 83. And that's a big move to the downside. If I just take my line here from this high to here, that's a 28% decline. And this year to date, it's down 8%. So it hasn't been participating in this upswing. So it's been downtrending and then kind of going in this sideways direction. And so could we say, well, it looks like it might continue at least down to this previous low around this 78.50. Could we buy a put? So if we come out to December, we've got 31 days. We could buy this put. Now, do we buy this $4 put at 85? That's, already in the money because it's below 85. This has a delta of 58. And what does that mean? Well, it means if the stock goes down by $1, this should increase by 58 cents. Or do we buy the 80, which is the at the money strike? And this delta of 33 means if it goes down by $1, this should increase in value by 33 cents. But this costs less than half as much. So percentage-wise, you're actually getting a bigger bang for your buck with this out of the money strike. And we've got lots of volume on both. And we could compare them and do, we could buy one at the 420 if we wanted to compare them. And then we could, buy 2 at the 80 and just see how it works out if you wanted to do those example trades. And if you said, well, it's at 82 now, we'd just be going to 78.50, like how much might we make if we did that? If you were looking to generate some income while the market or while a particular stock is pulling back. Yeah, so, we could come back to our trade tab, and I thought this was the coolest thing I'd ever seen the first time I saw it. you know, if we looked at, say, this 80, and I said, okay, I'm going to switch this to Theo price. And the first thing you do is hit reset. And then I'm going to say, okay, our target on this is 78.50. So if it went down by, say, 450, so I'm going to subtract 450, subtract 450. And we aren't even going to take volatility or anything into account. And then actually we need to pick a day. And then let's say, because today's the 18th, let's say it went down by 450 by next Tuesday. We're going to give it a week. What might this be worth? Well, it could be worth about 341. Like in rough math, 17 and 17 is 34. You know, it's not quite 100% return, but it's not too shabby. You know, so, you know, we could, you know, put that target in and then just say, you know, or we could say, hey, when this goes up and it's worth $3.40, get us out. Okay. So we're going to come to this 80 and we want to buy custom with an OCO bracket. And when we're doing a swing trade, and I need to put a swing trade plan in my collection of trading plans, but our rule of thumb is we say, hey, if we're paying $1.77, if this goes down, you know, by 50%, then I want out. So if this gets to the point where it's worth about 88 cents, I want to throw in the towel. And so if you're willing to risk, say, $1,000 on a trade, how many of these could you do? Well, we could probably do 5, right? So $1.77 times 5 is $8.85. So we could do 5, and I'm going to link these so that the quantities are the same. Okay. And we're going to make these both good till canceled. And then we're going to change our target on this was if it goes up to $3.40. So this is one way that we can do it based on the price of the option. Now we could also come here and click this sprocket and say, hey, when the stock goes down to 78.50 or below, get us out. That's another way that we could do it. Okay, so we're going to hit confirm and send. How much could we lose on this trade? And I need to do one other thing. I'm going to switch this to my larger account, because in our small account, we won't risk 1,000. We would only risk up to 500. So we could lose $885. How much could we make? 39,000. This is if Starbucks went to zero by December 19th. But what we're saying is, you know, if the value of this option goes up by $1.63, which would still be a nice return, excuse me, you know, given that we're paying $1.77 to get in, that's our target. Okay, so we're going to come down and put this in our long put bucket. Oh, sorry. Okay, and this is a swing target. Okay. Are there any questions on that one? Yeah. Okay. Yeah, someone said in the chat that they just lost a dog recently, and man, that is tough. Yeah, my heart goes out to you on that. They become part of your family. There's just no doubt about it. Okay, let's look at CMG. Now, Chipotle I don't know if any of you have ever gone to Chipotle, and I am not supposed to be making recommendations, but I think their food is pretty good, although I don't tend to do a lot of takeout. But this stock, holy smokes, Batman, it has been on the struggle bus this year. Like all the major indexes are in the green. Chipotle down 49%. Like, yikes. So, and the last earnings, the last two earnings, this poor thing has gapped down. I saw something at Halloween that, it was a tombstone for Humpty Dumpty, and underneath it said, "I was pushed." It looked like this one either got a push or it jumped off a ledge, didn't it? And then it did the same thing again. So, all the king's horses and all the king's men so far have had no luck in putting Chipotle back together again. But if we look at this, even though, it's up just a smidge today, could we look at this and say, like, even if it starts to consolidate and go sideways for a bit, because we've seen some sideways action on Chipotle, what are the odds of it going above 32.50 over the next couple of weeks? Yeah. So let's come to the trade tab. And if we come out to December on Chipotle, and we're going to go back to, I call this Barb's Basics, and because I've got probability of in the money and probability of touching on here. And if we said, well, we think it's likely to stay below 32.50. Now we have a 3-cent bid-ask spread. And if you look at an example trading plan, and I'll show you where to find that, part of the checklist is, does this trade more than 1 million shares a day? Check. Do you have at least 20 times the number of contracts you're thinking of trading? 10,000? Check. We're not going to do that many contracts. And do we have a tight bid-ask spread? 3 cents? Check. Well, what's the problem is these numbers are pretty small. So when we look at, if we did the 32.50 and we're selling a vertical because we want it to stay below that, we'd get 46 cents. So if you're saying, okay, 46 cents, is that good or not? Well, if we come and we look at, bring up our calculator, and we say, okay, I'm getting 46 cents, but what am I risking? I'm risking, $2.05. So I'm going to divide that by, 204. That's a 22% return. But our rule of thumb is that if I'm in it for 31 days, I want at least a 30% return on my risk. Well, what's my next choice is to go to 30, but it's trading above 30 right now, so it would have to drop. So I'd have to be pretty confident that it was going to fall further to do that. And if we come and look at the charts, would you be willing, to sell a call here? Yeah, I don't think so. And so you say, well, is that a rule or a guideline? It's like, yeah, 20%, we're in it for 30 days. No. So then what's your next choice? Well, your next choice is to say, okay, here's December 12th. Do I have different options here? Well, I could come to the 32. Maybe that would work. And just do the 32, 33. Would I get enough there? Well, here we'd get 26. So what's 26 divided by 74? That's over 30%. So it's about 35%, and we'd only be in it for 24 days. So that meets that criteria. Do we have enough volume? Yes. We certainly, this number hasn't changed. We still have a 3-cent bid-ask spread, so that's okay. So now we're cooking as long as we're okay with this being at 32. So let's move our line down to 32. Are we okay with that? And we're going, yeah, it's a little tighter, but you know what? Like these 2 days after it dropped, one day it was above. So since the last earnings, it's only had 1 day above 32. It closed at 32.50. The next day it was down at 31.69. So if we're comfortable with that, then we place that trade. So Jay Taylor, so if you're not comfortable with this strategy, let me just go over it quickly. And so the idea here with a short call vertical is that our expectation is that the stock is going to stay below $32. So what we're doing is we're going to sell a call. And when we sell a call, what are we agreeing to do? We're agreeing to sell stock that we don't happen to own. Okay. So we're going to sell that 32 and then and that carries with it unlimited risk. And we don't want to play that way we don't want to place a trade where there's unlimited risk. So above that, we buy a call. We buy a call. And so now this is called a short call vertical. Now, in the example that we're looking at selling the 32 and buying the 33. So how much could we lose on this trade? We could lose $1 minus what we're being paid to get in, which was 34 cents? Let me go look. Let's say it was 34 cents. So then actually my math was wrong. This should have been 66 if it was 34 cents. Okay. So let's go back and look at this. So this is how we're calculating our risk. So here's what we're risking. If we're getting paid 34, we're risking 66, and then our potential return on our risk is the 34 divided by 66. Okay. Okay. So let's go and look at this one again. Our trade tab. Oh, now we're getting 25. So, 25 divided by 75. 74 is close enough. 34%. So because we're risking $1, if we're being paid 25, then we're risking 75 cents. Okay. And so if we're saying, okay, we're okay with that. Okay. So we're going to come to a first trigger sequence. And on these, we put in a target. And our target is to get out when we've got 80% of our max gain. Now, if we're willing to risk $1,000, how many of these can we do? Well, we take 1,000 and we divide it by the $75 per contract that we're risking. So we could do 13. Hey, I was born on the 13th of a particular month. So let's call that lucky 13. Okay. And then with our first trigger sequence, we're going to right click anywhere on this and say, hey, when this gets to the point where it's worth a nickel, we're going to buy it back. We're going to make that good till canceled. So we can see now when we bring up our order confirmation page that the most we can lose on this is 975. The most we can make is 325. Yeah. A bearish synthetic. Somebody's asking, would a synthetic be an option? And so, like, if you're bullish, a synthetic is where you are trying to, in essence, have the same exposure as if you bought the stock and you buy a call and sell a put. But that's a bullish strategy. And this is a bearish to neutral strategy. Okay. So we're leaning towards being bearish on this. We're kind of sort of bearish is how I like to describe it. Because our expectation here, if I put this on the chart, 32 and 33 for December 12th, I think it is. Let me get my calendar. Yes, for the 12th. Over the next, between now and the 12th, what we are expecting to have happen is that Chipotle is going to stay below this. If I were doing a synthetic, I'm buying a call, which means a long synthetic, I'm expecting it to go up. Yeah. And if I'm not bullish on this, then, I would choose a different strategy. Yeah. So that's why I went with that one. But keep the questions coming. Okay. And do you notice that we went through a lot of, here are our rules, and this isn't going to meet our rules. So is there another way we can place this trade? My expectation when I first looked at this morning was that we were going to say, actually, we cannot place this trade because it doesn't fit in with our rules. And sometimes the best trade is no trade at all. Okay. So it's okay to not place a trade, even though the entry may look delicious. But if you're wondering where I came up with these trading plans, and nerd alert, and I'm talking about myself here, like when I first started with this education, and I'm a student of this education, right? Like, so I learned by coming to webcasts and doing the courses that you can do on Schwab and all of that stuff. And I saw these example trading plans, and then I would create a checklist. And so for the short call vertical, it would be, is the stock down trending? Is there an entry? And then, there's 5 components, right? What to trade, when to trade, how much to trade, when to exit, and what are your routines to manage it? Okay. So here's an example trading plan from, and it just provides a framework from which you can then place, create your own trading plan and your own checklist if you want to be a nerd like me. And then I created another one for long put verticals. So those are okay, spoiler alert. So far, we've done a long put with a swing target, a swing created target. We've done a short call vertical. Let's come and look at a long put vertical opportunity. And then if you want to see a trading plan, here we go. And this is why you'll want to subscribe, by the way, to the Trader Talks channel, because there's all this content is in here, so there we go. Okay. So let's come and look now at Meta. Let's come and look at Meta. Okay. So Meta, it's basically gone a whole lot of nowhere this year. Actually, it's gone down a lot. It's gone up a lot. It's gone from below 500 to almost 800, which is a pretty dramatic increase. But, it's been struggling lately. And, the last earnings, it broke down and it's continued to fall. And it's had about 594 here. And, we've seen it's had a couple of up days, but overall, it's been downtrending. And since it hit this high here, it's down almost 25%. And so if we looked at this and said, okay, if I'm bearish on this, could I, and this was, currently this candle is red because, it's down 1.3%, but it opened lower and is now moving a bit higher. When I looked at this first thing this morning, it was still trading lower than where it opened. But if we looked at this and said, it's at 593, could I expect that it might continue to fall here and look at, if we came out to December, if we did the 595, and again, does it trade more than 1 million shares a day? Check. Do we have lots of volume on these contracts? Thousands, so check. Is there a tight bid-ask spread? It's 25 cents on a $22 option, so check. And so might we expect it to fall by another $2.80? Well, if your answer is yes, in the next 30 some days, actually, I don't want to sell a vertical. We want to buy a vertical, because by buying the put at $5.95 and then selling the put at $5.90, we're going to get our max gain if it goes below $5.90 and stays there. And so our example trading plan, what we say is we want a 50% return. So, and how much of a return could we get? Well, we're paying $240. The most we can make is $260. We're saying, I know we could make $260, but if I can make $1.20 a share, $120, I'm going to be a happy camper. That's a 50% return in 31 days or less. Okay, so, and if you're not happy with that, then put in a different target. But we're going to say, yeah, that looks good to us. And so if it goes down, it might hit our profit target and get us out. And then, and then we're out of the trade, and then if it rallies after that, then we don't care. We're just expecting there to continue to be a downtrend, especially given the market's been pulling back as well. So we're going to create an opposite order. How many of these are we going to do? Well, if we did 4 of these, that would be under 1,000. So there's our 4. We're going to make this good till canceled. And 235 times 1.5 is 353. So we're going to make this 353. And we're leaving money on the table, and we're okay with that. But if we could make a 50% return, we're saying, yeah, we'd be happy with that. But how much could we lose? We could lose this whole $940. So our plan is that we're going to look at these on a daily basis, and we're going to say, hey, if this gets to the point where it's down 50%, we're going to exit the trade. Okay. And how often are we going to check? We're going to check every day. And so some of you may be thinking like, okay, why are you not putting in an OCO order? Then I don't have to check every day. Well, here's why. Because sometimes when the market first opens, there's a lot of volatility. Anybody else ever notice that? And so what's happened to me in my live account is that sometimes due to market volatility, it triggers my stop or my exit, and I get out for a way bigger hit than 50% loss. And then the market settles down and I wouldn't have been stopped out at all. So if the market volatility stops me out for my 50% profit, I'm willing to fall on that, grenade and take the profit. But I don't want to take an 80 or 90% loss because of market volatility and then have the market settle down. So instead, we are going to come and check every day. And so when we come down here to our long put verticals, now, and you may say, well, how can I make it easy? Well, when I look at this, all I can see is I'm up $10. So what I'm going to do is I'm going to come to my sprocket and I am going to type in profit and loss percentage, and I'm going to add that. Why is this? I want to add that. Okay. So now I've got a profit and loss percentage. And I can see I'm up by 3%. So when you're doing your daily check on these, you can say, hey, am I close to 80%? If I'm up 70%, then I may just, want to call it a day. And here on the short call vertical, this is the one we just put in. And because of the bid-ask spread, often you end up in a loss right at the beginning. But for CMG, we're down 8%. And so at a glance, I can see, like, have I got work to do here? Okay. Yeah. And, you know, like if you're following along in your paper money, so Mary's saying, feels like this one's more of a coin toss. It could go, you know, could go up or down. And so you may want to put that in the notes when you place the trade. It's like placing the trade to follow along. But like, this is what I would do as a client. I would have said, I wouldn't have actually placed that trade. And if you wouldn't have, I'm just, you know, coming up with examples here. And so if you want to show it on your chart, you can just draw a line and then edit it. Well, I don't want to activate it. Here, I'm editing this, and it's going to be it's a long put vertical at 585 and 590. And it's December 19th, or is it 18th? 19th. And we want it to go below 585. That's the expectation. I'm not saying the word hope, because hope is a 4-letter word in the world of trading. So we'll see our max gain, or we'll hit more likely to hit our target if it goes below and then stays below. Okay. So if we come and we look at Boeing, like here's another example where, you know, this is up 6% year to date. So it has been uptrending, but has it been uptrending lately? And lately, I would say no, because it's gone, you know, it's down by what, 25%? You know, from this high here, this thing has fallen 22%, you know, since this high back here at the end of July. And it, you know, kind of hung out here for a week, and today it's breaking below that. So we could do a couple of things. We could do a short call vertical. Remember, that's the one where we are, and we did an example of that already, you know, saying, you know, maybe here around this 193 with the expectation that it might stay below that. Or we could do a long put vertical. And if it's trading at 188, I kind of like to bracket them and do like, you know, 185 and 190. So it doesn't have to go that far, you know, but if it's at 189, like, could we actually do one where it's already below that? Could we do the, you know, 190 as a target, you know, where it doesn't have to, you know, it just has to stay here. So we could also do a long call vertical. You know, and if we did it here, then it just has to stay below. It doesn't even have to travel. But usually you have to pay more for those. And then sometimes it's harder to get the kind of profit you want. You know, so if we looked at 195 and 190, it's already below both of those strikes. So if we came out here to December 19th, we've got lots of volume, thousands of contracts, millions of shares traded. So check, tight bid-ask spreads. So could we come and buy a vertical here at 195 and 190? And, you know, so we'd want, you know, this to get to be worth about 450 to get our 50%. But, you know, do you have to go for 50%? You know, we don't. We could say, well, if I got 25%, I'd be happy. You know, when it's already through both strikes. Maybe you have a rule, your example trading plan says, if it's already through both strikes when I place the trade, I'm happy to take a 30% return. So then you'd say, okay, what's 308 times 1.3 is $4. So when this gets to $4, I'm going to consider it, you know, having reached my target. And so, and we're going to go for a little lower profit target here. We're going to say, hey, if we can make a 30% return, which is if we can make $1, well, it would be about $3.90 would be a 30% return, right? 3 times 1.3, $3.90. Good till canceled. So we could lose 900. We could make a max of 600. We're going for that 30% return. And this is going in our long put vertical bucket. Now, if we did the short call, we'd want to pick a strike that is above where we think it will trade. So we might say we want it to be above this like 193, and there might not be a 193. So we might have to come up here to 195. And again, we've got thousands of contracts. So if we come up to the 195 and we're looking at selling, we get $1.50. And so how much are we risking? 5 minus $1.50. So it's 150 divided by 350. What's our rule? Our guideline is we want, if we're in this for 30 days, we want at least a 30% return. We're getting 42. How much are we risking? 350. So how many can we do? 3 puts us just over the 1,000 by $50 if we're okay with that. Single order, first sugar sequence. Say, hey, when we've got 80% of our max gain, we want to exit. So when this is worth about 30 cents, maybe 29, let's go 30. We want to exit. Confirm and send. So now we can compare this. If I get to fill in for James again. So we can compare this to the long put vertical. Okay. So guys, yes, we did both of these trades because we are bearish. So with this one here, if I edit this and make this 195, we did a short call vertical at 195 and 200. So the expectation here is that we're expecting this to stay below 195 for the next 30 days. And we could be wrong, which is why position sizing is so important. So, but it's now trading at 189. So, you know, it's got $6 worth of wiggle room before we're in trouble. So if it continues to go down, we're happy campers. If it goes sideways, we're happy campers. If it comes up, it can come up by $6 and we're still okay. But with a short call vertical, yes, we are risking more than we are getting back. And yeah, you know what? In the trade management mini sessions that I showed you, sorry. Oh, there, it was the last one. Sorry, guys. Here in this, there in the orange section is a trade review. So I could record something and put it in here if I don't get to fill in for Mr. Boyd again. So guys, that's a wrap. Please hit the like button. It helps move this up in the algorithm so more people can find this content. Please subscribe to the channel if you haven't done that already. Please follow Mr. Brent Moores and I in the land of X, Brent Moores CS and Barb Armstrong CS. And I want to thank Brent and the guys behind the scenes for helping bring this class to life. Thank you for your patience and for joining me today. I hope you found this helpful. Take care, everyone. I will be on again with Getting Started with Technical Analysis at 2 o'clock Eastern. I hope you'll join me then. Bye for now.